So the additional at the assertion level, guys, revenue is specifically highlighted as carrying a fraud risk. Revenue recognition, recognizing it too early in order to increase revenue and obviously appear to be doing better than what they really are. That's the one item that they specifically address as a fraud risk at the assertion level. The rest are not addressed as risks, but when they get to the response to risks at the assertion level, they discuss that you have to do additional work on estimates and additional work on transactions that are unusual and significant. So that not in the normal course of business, and on year-end journal entries, adjusting entries. So although they aren't specifically highlighted as having a fraud risk, by giving specific responses to these, we can see that each of these do actually carry a fraud risk. So as soon as you see them in a scenario, an estimate, you can say that there's a risk here of fraud because there could be a bias in determining that estimate. Or unusual transaction not in the normal course of business, there could be fraud here because it is doesn't make sense as to why they actually have this transactional balance. Other than that, guys, you're going to be looking at the information in the question and seeing if there's any of these indicators in Appendix 1 and 3 that are specific to a balance or transaction, in which case there could be a fraud risk assigned. We then have to respond to those. So responding at a financial statement level, guys, nice and simple. It's the very same procedures that we do in responding to the risk at a financial statement level for error. In ISA240, paragraph A1, the only additional one here is to evaluate whether any accounting policies could be indicative of fraud. What do you have accounting policies for? Estimates. So look at their depreciation policy. Does that indicate that they are not writing off their assets as quickly as they should be? Or look at how they are working at the allowance for credit losses. Is that an indicator that they are trying to overstate accounts receivables? Other than that, when you respond at a financial statement level, you're adapting your resources. So increase professional skepticism, assign more experienced staff, increase supervision, increase the elements of unpredictability. Pretty much the same as what came out of 33A1. Nice and simple. So how do we then respond at the assertion level? In planning, we say we adapt our audit plan. We had to first discuss our approach. And our approach could be, I'll put that up here, could either be combined or substantive. Now we think that there's a risk of fraud. Do I want to go and test to see if some of the controls are working, or do I want to test the detail to see whether there really is fraud? You want to go more detailed. So you will choose to go with a substantive approach. And therefore the nature of your testing, you will do test of detail and analytical procedures. The timing, you will try to come in at year end, because if you come in at an interim stage, they could still manipulate. So you come in right at the end and you don't give them a chance to manipulate and you not pick it up. And your extent, you will do increased test of detail, and you'll do less analyticals. You will also note here that you will place less reliance on management rep letters because there's been fraud. So I don't know whether their management representation letters are actually quite fair. Appendix 2 has specific responses to actual risks. So let's go and have a look at Appendix 2. So here's Appendix 2 and it says, following are some examples of responses. Maybe you go and visit locations on a surprise or unannounced basis so they don't know. You request that inventory are counted before the end of the reporting date. You send written confirmations to your external contacts instead of oral. Perform substantive analyticals on disaggregated data. So don't take the full amount, try and break it up and try and find out where there could be actual issues. Performing audit procedures on opening balances using computer-assisted audit techniques. And then they go and say, okay, let's give you specific ones for specific balances or transactions. So for revenue recognition, you could do some substantive analytical procedures, or you could even get an external confirmation for specific contracts from customers. Okay, you could get legal and in-house counsel with regards to any goods in transit over year end to see whether revenue needs to be recorded or not. For inventory, you can actually go to locations to examine the goods there. You do your own test inventory counts. Go and examine the contents of the goods in the boxes to make sure that it is right. Do some analytical procedures to see if there are huge discrepancies in quantities at different locations and so on. For estimates, get an expert to help you to see if there are any strange assumptions that have been taken into account. Okay, and then specific responses, potentially because of theft, go and count cash that they say that they have. Confirmation with customers specifically for their debtors or creditors terms. Key ratios can help you. Reviewing authorization of related party transactions. And that's about it. Okay, so you can go and have a look at those in a question to help you develop further substantive procedures when you are getting to the testing.